Okay, let's get straight to it. If I only had $100 to begin investing today, not 10,000, not 1,000, just 100. Here's exactly what I would buy and why. And I'm going to keep this simple and beginner friendly. So if any of that sounds interesting to you, make sure to stay tuned. So just to be clear, I'm not a financial advisor and this isn't advice. I just want to get that disclaimer out the way before we get started, because it's important to understand that everything that we're talking about is just a documentation of my personal experience and knowledge when it comes to long-term investing. And I try to break down things in a way that's simple and easy for beginners to understand. But none of it is financial advice. So just try to make sure to keep that in mind, because everything that we're about to discuss is only one way to start your financial journey. If I had $100 to start off with starting right now, this is what I would do. But that doesn't mean that's what you have to do. Does that make sense? So starting off, if I only had $100 to begin my investing journey today, I wouldn't try to be fancy or anything like that. Instead, I'd start with building a foundation. My first investment would be SPY or SPYM. These track the S&P 500, which is 500 of the largest companies in the US. This gives you Apple, Microsoft, Nvidia, Amazon, and many others all in one ETF. The allocation example would be $60 or 60% into SPY or SPYM. Why? Because this is the foundation of the US market. So it diversifies your money across the US market with 500 different companies. After that, I'd buy some growth with QQQ or QQQM. Now, these follow the NASDAQ 100. They're more tech-heavy, growth-focused, and more volatile than SPY or SPYM. The allocation example would be 25% or $25 into QQQM or QQQ. This is where we tilt slightly towards growth. The companies in these ETFs are very growth-focused, so you'll see more long-term growth over time. Last, but certainly not least, we got SCHD. This one focuses on strong dividend-paying companies with really good fundamentals. You're going to see lower volatility, steady dividend growth, and quality companies in this ETF. The allocation example would be $15 or 15% into SCHD. This gives you a little income focus without chasing crazy yields. Okay, real quick public service announcement. You do not need to buy a full share of any of these tickers that we've discussed. Some people may look at the S&P 500 and think to themselves, I can't afford this, especially when you're starting off small, like a $100 budget. But that couldn't be further from the truth. Most brokerages will allow for you to buy fractional shares. That means you can invest $5, $10, or $20 at a time and get started. You don't need to buy full shares. Fractional shares remove the price barrier, and you can start small and stay consistent. Now, keep this in mind. The most important part isn't the $100. It isn't where you start at. It's what happens afterwards. If you invest $100 once, that's a nice start. If you invest $100 every month, that's a game changer. Even $25 per week matters. This is where compounding does the heavy lifting. Now, let's set up some realistic expectations here. None of this is going to make you a millionaire overnight, and you shouldn't expect it to. This is about setting up a foundation that can last you 5 years, 10 years, 15 or 20 years, and build up the compounding that's necessary to become that millionaire that you want to be someday. So, in closing, if I only had $100 to begin my investing journey today, I'd keep it pretty simple. I'd start with building a core out of SPY and SPYM. I'd add some growth with QQQ or QQQM, and then I'd add some dividends with SCHD. And I'd automate the entire process within my brokerage. Nothing fancy, nothing crazy, just consistency and letting compounding do the heavy lifting over time. All that said, if you got some value from this video, then please make sure to like, follow, and subscribe for more beginner-friendly stock content like this, and I'll catch you in the next video. Take care.